Welcome to Weekly Market View. I'm here with Bill Hubard and we are reviewing the markets in the week ahead. A tough call, I think, this week. The FTSE, all stock markets making good record highs, and yet there seems to be the fear of inflation, of unemployment around Europe. What do you think? What's your take?
Well, we talked about this before. I'm not, sell in May and go away, but I guess I was a member of the same school in January that predicted the FTSE, the DAX, XYZ, to be X by the end of the year. Well, we reached most of these levels in March. So now it's a situation where, are we taking some money off the table? But one of the things, are we seeing rotation? I mean, classic would be Apple versus Google. You're selling Apple, buying Google. Also a situation, are you selling European automobiles and buying, we're having a phenomenal year with the American automobile industry. So are you buying that? Are you just rotating stocks? I mean, a classic is, in the first, 5 or 6 years of this millennium, 7 of the biggest movers, and they were probably like more than 3/4 of the improvement in the FTSE were Fresnillo, Vedanta. They were the oil, mine, and minerals. Well, now they've been the big laggards here, for the past couple of years, as we've seen now with the sell-off in commodities. One of the things, though, and you just mentioned about inflation does not exist anywhere. Even with the Federal Reserve's preferred employment cost index, it's only at 1.1%. And as we saw that last night with the U.S. Treasury, 1.6% of the 10-year, and this morning going into the market, which we received the ECB rate cut, we had the French 10-year at 1.69%, the lowest on record, or at least since the French Revolution, and even Italian 2 years at 1.05, the lowest in history. So people, whether you're saying we're in the bond market, let's be safe, and the concept there is the return of my money rather than the return on my money.
Okay, and so you talk about rotation in the mining sector. I see, obviously, I know the gold price is starting to recover somewhat, but you're right, it has been a bit of an underperformance. Yes. Is that a reflection of lack of spending in commodities generally?
Well, I think one of the things that you have to look at is, let's just say the easy money in mining, whether it be diamonds, whether it be oil, whether it be XYZ, has been done. Now the question is whether it's health and safety. You have to go down another 200 or 300 feet. So the cost of bringing out that raw material is becoming very expensive. Hence the reason you're starting to see the movements, whether it be shale oil, shale gas, and even, you saw Norway, again, unlike us, where we still think that the North Sea will be producing, oil for our great-great-great-grandchildren. Norway's, oil production is like 27% in the past 5 years. So they're starting exploration in the Arctic. So again, you're starting in new areas that are more expensive. Also, the simple fact is, right or wrong, a number of the areas where we're looking to do the mining, whether it be union problems, whether it be disruption, etc., and unfortunately, some of the deals that are being done in some of the more shady areas of the world, if you get my drift.
Yeah, I suppose always a reflection. You need the cost of it, the price of these commodities to stay high, just to justify the cost of digging them out of the ground.
Yeah.
Okay, so what about Apple? You mentioned Apple. There's been a bit of an interesting story this week. It seems to be another one, a bit similar to gold, a bit of a commodity, a bit of a share on the bounce. Do you think they got it right there? The buyback program they're going through, the bond issue.
I'm probably not the right person to talk to. I still have a dial-up telephone and a black and white television. So I'm not into the 21st century. I'm not even into the 19th century. But one of the things that you are seeing, you see movements upside. Nokia, Samsung, 2 or 3 years ago, these were like on their last legs. So are we starting to see moves in there? One of the things I am seeing is the amount of new money going into projects. 25, 30 years ago it was Microsoft and Apple and Facebook. Who knows what these new numbers are? And I was just reading some of the reports from the Milken Conference in 2013. There's a tremendous amount of new projects, angels, and we're talking about billions of dollars going into this. So information technology definitely is going to be around for the next 5 or 10 years. And one of the things that we're seeing is a major transformation. So in an area that people weren't looking at 4 or 5 years ago, this is, to me, leading, at least with the FTSE, and at least with the United States indices, and probably even in some of the France and in Germany. This is where we're seeing major moves up, the IT area.
Okay, so if I can finish with kind of trying to press you, we've kind of talked earlier about there is money out there. There does appear to be anecdotally a lot of money outside the finance sector that's sitting in the wings. Where do you think it is going? I mean, obviously it's starting to drift into the bond market as opposed to the equities. Is that a trend that will continue?
I think it will. I mean, because one of the things, as we saw last night from the Federal Reserve, basically 99% of the statement was the same as March, where I felt from day one people had misinterpreted March when they were talking. The new word was tapering. The Federal Reserve was going to taper off, QE3. Well, they're not going to. I mean, the market now is implying we won't get any change from the Federal Reserve through the first quarter of next year. Hence the reason a massive move into the bond market. We're going to get another, I think, negative number tomorrow out of non-farm payrolls. My talk is 110,000. I think the consensus at Bloomberg was 145, and maybe even lowered. That's the ADP numbers. I haven't seen the Challenger report today. But it's a situation where one of the things, though, where if you're looking at some of these numbers, I think us older people were taught one thing, but demographics people aren't looking at, okay? We're all getting older, so are we working less hours? Also in the States, which is something that's, I want to say new, maybe the last 25 years, temps. People working 2 or 3 days. I'd rather have some job than no job. And we've had this in the UK for a while. So it's a situation where the thing that's helping that is if you're a temp or not permanent, then you're getting a small wage. But inflation is not eating away at that wage. So it's really a situation where, businesses are not hiring because, again, inventory levels down, consumer, 6 months, a year from now, are we going to be buying? We saw it with houses here in the UK. Well, we had a 1 month drop off. Well, you sell a house. Well, it's not just a house. You got to sell carpets and telephones and X, Y, Z. So the consumer, and I mean, I see it, now that I live in the country, I mean, the consumer is really hurting, okay? I mean, you go out for an Indian, you go out for a pizza. You're not going out for a 5-course meal with pate and champagne, et cetera, okay? And you're really counting the pennies. And until that philosophy changes, and unfortunately, I don't want to be negative, I don't see it changing anytime soon, whether interest rates, whether it be here from the UK, the ECB, or the Federal Reserve. The consumer is concerned. And here in the UK, you've got inflation greater than wage price appreciation. So now I see the money. I see with the professionals. I see the market still going up, but it's a situation. It's just a rotation. Okay, how much new money is coming in? I don't know, but I don't see it. I see the money markets funds in the States, the bond market funds in the States. Bond market funds doing better. Money markets not changing, but they're not. The individual is not plowing in to the equity market, maybe because, well, I should have done that 3 or 4 years ago. So.
Okay.
So that was a short, succinct answer.
Thanks very much, Phil. Thank you.